So it really is our mission. Impact investing is something that a lot of people have thrown around. But our focus is very, specialized in the sense is that we want to invest in low-income neighborhoods to produce significant social benefits. What does that mean? Robert, you have a bit of experience, working on the side from an impact point of view. Maybe get some color, something tangible that people would appreciate from an opportunity zone investment that you've worked on in the past that, had an impact like increasing, affordable housing units and what that had, in terms of its impact on the larger community.
Yeah, I think a really good example would be the asset that we actually won a national award. HUD meets once every 3 years, and they give out awards, and we won the best turnaround property in the country that year. And if you had been in the business, you would, what I heard on a consistent basis, if you can turn this around, you can turn anything around, Robert. And what I found in these opportunity zones that folks go in, before they were declinated opportunity zones, they go in and they get, tax incentives, they get low income tax credits, et cetera, but they didn't understand the dynamics of the culture, and so they would forget that. And a lot of times they would fail, like the property we're getting ready to buy now in Houston has had a string of 2 or 3 owners that they've had assistance from the city, low income tax credits, and it's still not successful. So, and again, it has to do with how you work with the community. So the deal that we did in Greensboro, it had an MS-13 recruitment center in there. And we went in there and not only lifted up and made a good investment to win the award, but we lifted up the community. And how that's dealt with is the relationships that you create on the community through your staff and through the different partnerships that you create with cities and nonprofits, et cetera, to do that. And that's one of the key components that I see is missed a lot in these opportunity zones. And I'm hoping through many of the groups I'm working with around the country to put together a template that we can teach others on how to go into these zones and not just make a good investment, but a physical investment and returns, but at the same time, teach others how to lift the community up. For example, there is a group out of Dallas called Apartment Life. They're on about 600 apartment communities across the country. 85% of the owners invite them to come on their property because of the returns. It costs about $20,000 a year, and they'll get an average increase of about $200K NOI on their bottom line. So about 85% of the owners bring them on for that fact and reason alone. The end result is that they actually create a sense of community, and one of the reasons the NOI is so much higher is because the resident retention goes up through the roof compared to what they had before. So just knowing these different pieces is like baking a cake. If you know how to do it and you know the right ingredients to add, you can have an incredible investment, but do it for the right reasons and actually leave a lasting legacy when you get completed with these projects.
Thanks, Robert. Yeah, no, I think what's been overlooked is the actual impact of this opportunity zone investing. I think tax benefits are, as Trump would say, huge, and we wouldn't disagree. But what's really, I think important to understand is that this is really about changing communities, and a lot of these opportunities that we're kind of sorting through right now, the neighborhoods that they're in, they're distressed neighborhoods, and it's not just the properties themselves, but it's also, the families and the communities that are within these properties. And so, Robert mentioned, some of our relationship with nonprofits. And before we get into the nuts and bolts, And I think that's really the tax benefits, and we have some great examples on that. Robert, why don't you share a little bit about that group that has more of an outreach focus when it comes to connecting with the tenants involved in the properties?
So Apartment Life, they have a unique model, and what they do is they will partner with a local church or ministry that is already making a difference in the community and invite them to bring, usually it's a husband and wife couple, doesn't always have to be, and they would live on the property and be the community director, right? And they would be the welcome wagon, kind of the whole thing. And, they would, it's really a call and a passion to help and assist others, right? And that, again, is the reason that it makes such a difference. And we're looking to also partner with other groups that are going to, in the same aspect, help our veterans, help our seniors, et cetera. And so what we do when we go into these different areas, we look to partner with national organizations, local organizations, and it's also important to know how to work with the city. For example, where we won the award, the city was literally not just didn't approve it, but their whole staff was on our team. I mean, they literally were running up the hill with us. And that makes all the difference in the world when you can create these partnerships, when you go into what now is, an opportunity zone.
Definitely. And then I think one last thing that's worth mentioning is that, as we get into, the nuts and bolts of the tax benefits and some of the investment examples, as investors, what's important to keep in mind is that, what do our partnerships rest on? And so I think one more thing I'd maybe like you to touch on, Robert, is just that, when we consider the relationships that we have in the marketplace and the visions and the missions that they have as well, how would you describe, the type of impact investing that we really are focused on?
Could you be, I'm not sure exactly what you're asking when you want me to focus on a particular point of impact?
Yeah, I mean, I think what we have espoused, pretty, unapologetically is that, we're a faith-based group that is really geared towards what I would call kingdom impact investing. And so, before we get into kind of the nuts and bolts, I think that's probably fruitful to talk about a little bit more in depth before we get into it. So if you want to comment a little bit more about that, Robert, and then I'll jump right into the examples.
Right. Yeah. So, the impact investing that we do, most of the groups that I'm serving now, or that Dylan and I are serving, are faith-based groups. Same thing with Apartment Life. They're a faith-based group. Another group in Orlando is a faith-based group. And we're really about not just saying about making impact, like the group that I'm partners with out of Orlando. We actually have it in our operating agreement that we give away 50% of our profits for other kingdom impact investing, or even going straight into other ministries that help our veterans, that help homeless, et cetera, like that, to truly lift up a community and a neighborhood. And so most of the folks that we're working with are not just there to make a good return, a good investment, but truly are called to make an impact, in the communities where we are working.
Yeah, I just think that's so important to talk about first, because when people think about real estate developers, sometimes the focus is that it's purely profit oriented, and frankly, when we consider the changes involved to really redevelop a property, sometimes it's surface level impact that they're able to live in a more safe community. But from a higher level point of view, is that poverty is a real thing that starts not necessarily on the outside, but more on the inside. So we look to really combat that as well. So I think it makes sense just to go into, why, U.S. Treasury designated opportunity zones, and really what they're about first. So this is a byproduct of the Tax Cuts and Jobs Act of 2017. Again, it's been a very generous tax incentive program to promote economic development. I would say approximately 8,700 low-income census districts tracts have been identified in all 50 states and Puerto Rico. And most of them which have been selected personally by governors and then certified following by the U.S. Treasury. So the basis, the basic description of what the legislation is about is that taxpayers, businesses, and individuals through unrealized capital gains can achieve more significant tax benefits through deferral, reduction, and exemption, and deploy these existing gains and recycle them into qualified opportunity zone funds that thereby invest into investments located in these tracts. Now, there's some rules around this that we're going to go into a little bit more. For illustrative purposes, we're going to kind of dissect an example. But for a qualified opportunity zone fund, which is how I would designate our fund, 90% of the assets must be invested into these zones. And for taxpayers or investors or capital groups, the period of time they have to invest these capital gains that they have sitting from existing properties or investments or concentrated stock positions is approximately 180 days. So that's just like the basic background. I like pictures. Keeps it very simple. Gives an idea of like where everything is from an opportunity zone census tract point of view. It's all over the country. I think the one area that we're not showing as visibly as Puerto Rico, but as you can see, they're literally all over the country. Now, as a group, we have a nationwide focus. It's really about, again, the dynamics of the risk and reward and the communities that are, being considered, and what the greatest impact can be that we can deliver for the investors and the community collectively. Little pieces of information about the zones. At least 20% or more of the median family incomes can be no greater than 80% of the surrounding area. As I mentioned before, state governors were allowed discretion to select 25% of the tracts in their respective states. So this is a helpful example that we're just terming Meet Richard. So Richard is somebody that personally I've met a lot recently. There's kind of a cloud of, what are the rules? How does it look? For somebody that has an investment in something that's been successful, it's been profitable. So for illustrative purposes, Richard is somebody that's had a long-term investment in Apple stock. Richard invested $500,000 at the point of purchase. This year, though, he's going to sell it for a profit of $1 million. And so what we're going to walk through year by year, we're going to skip a few years, is this: what are the implications of Richard investing his profit into an opportunity zone fund? So first and foremost, he's going to be reducing his federal and state tax liability that would traditionally be approximately $293,000. So he's going to invest $1 million of the realized gain from Apple stock into a qualified opportunity zone fund within the time period of 180 days that's required. This does a couple things. So first and foremost, it defers the payment of capital gains tax, which is very important, until the earlier of either or, the sale of his investment in the Qualified Opportunity Zone Fund, or by April 15th, 2027. So long time away. So the follow-up point that's important to consider is just the time frames at which the next trigger for the tax benefits come along. So the first one would be 5 years after their initial investment. So Richard's deferred gain is going to be decreased by 10%, or by 100,000. So the $1 million capital gain is going to be reduced to a $900,000 capital gain. So that's that 10% reduction, 10% deferral by 10% after 5 years, after the initial investment. Now, after 7 years, this deferred gain is going to be decreased by an additional 5%, or 50,000. So the $900,000 capital gain is going to be reduced to a $850,000 capital gain. Now, for the following year, Richard includes the deferred and reduced capital gain of $850,000 on his 2026 tax return. So his capital gain tax due in 2027 is now $249,050, approximately $44,000 less than the $293,000 that would be due in 2020. So in summation, what this represents is a 15% reduction in its capital gains liability, which again is very huge. I mean, it's considerable. And that savings is going to be able to be reinvested in a way that, a standard investment would not allow. So we have a better, kind of a more illustrative example on the following slide. It shows the compare and contrast of the standard model of investment and a Qualified Opportunity Zone Fund investment. But just to kind of sum it up shortly, in 2029, Richard would do one of two things. So he would sell his Qualified Opportunity Zone investment that he held for over 10 years, which would be the maximum time to take advantage of the tax benefits. And the proceeds, assuming a nominal 8% annualized net return, would be $2.1 million. And so what's important about this is that Richard pays no capital gain tax on that additional approximate $1.1 million gain. And this is all because of the Qualified Opportunity Zone program, that Richard saves approximately $340,000 in capital gains tax that, again, he does not have to pay and is going to be reinvested. So again, purely for illustrative purposes only, not intended to predict performance. But in short, Richard would earn approximately $623,000 more in a Qualified Opportunity Zone Fund, purely because of the tax benefits. Now, for a standard investment, you can see next to that, we're to compare that to a Qualified Opportunity Zone Fund investment. So to define these first, we've already talked about, what it means to invest in a Qualified Opportunity Zone Fund. What are the rules beyond that? The standard investment procedure would be one of where, his Apple position is disposed of, and how or why would somebody want to, liquidate a position that has $1 million gain? Frankly, sometimes it's just as common just to reallocate exposure. As gains get more substantial, in a sense, the position risk increases. So oftentimes a manager or even investor would look to, shave off some gains or totally reallocate into something else. So for Richard, those considerations would likely be in his mind. And for a standard investment that he would consider afterwards, he would, obviously pay taxes right after, and then he would reinvest into a non-qualified opportunity zone fund investment. And the subsequent follow-up of that is that, again, based off whether it was totally reallocated or liquidated in the future, he wouldn't be able to avoid or even reduce taxable considerations. So let's kind of walk down the table here. Both options start with $1 million. Both have a net return assumption of 8%. For the standard investment, there's actually an initial capital gains tax of $293,000. And for the qualified opportunity zone fund investment, there is no initial capital gains tax because of the deferral. It's available for several years out. So, being that there's an initial tax for a standard investment, the initial investment is actually going to be significantly lower. Which again, if we were to consider the race, between the standard investment and the qualified opportunity zone fund investment, there's a drag for the standard investment already, which isn't the end of the world, but again, as we go further down the line, it tends to make a big difference. So for total investment gains, you have approximately $820,000 for the standard, 1.1 for the qualified opportunity zone fund investment. Gross proceeds at liquidation, significant difference between the two. I would say approximately $700,000. Now, for the payment of deferred and reduced capital gains tax due in 2027 for the standard investment, there would be none. And for the qualified opportunity zone fund investment, there would be one. And that would be approximately $250,000. Now, at the second liquidation of the standard investment, assuming an 8% return, there would be capital gains tax on the standard investment, and that would be approximately $240,000. Now, for the qualified opportunity zone fund investment, there would be none. So, you see at the bottom is that the net dollar return between the two is almost a difference of, again, $700,000, and the approximate is $623,000 more for the qualified opportunity zone fund investor. So as I said before, for illustrative purposes only, it's not intended to predict performance, but I will say is that a 8% return assumption is rather, agreeable for the types of opportunities that we're looking at. So the spread between the two is obviously, as you can see at the bottom, quite significant. Robert, I'll let you kind of jump in on this. The bottom line is always the bottom line. It's important to talk about that from tax benefit point of view. But, is there anything that you feel it would be important for investors to know, consider when considering this style of investing?
I mean, the one question that I get asked all the time, or point that I get shared, and you just addressed it. A lot of folks, when they think about the opportunity zone, they go, well, geez, I'm only going to, say 15% or so over 10 years on my capital gains. And my comment to them is this as well. You have kind of two choices, right? You can pay the capital gains tax, or you can invest in an opportunity zone. The decrease in your capital gains tax, to me, is really not the play with an opportunity zone. And I just like to use simple investments. We've done value add repositions where we've acquired an existing asset in areas that are now opportunity zones. So say we did a $10 million deal, right? And we put $2 million into it. And we've had properties that have actually doubled in value, right? And so then you put long-term debt on it, and maybe you get some type of a HUD product, 85%. I think, you have equity of about $3 million, right? So that to me is where the play is. And when you start compounding that, you're able to pull that. I think, folks that are in the space realize you can pull that out tax-free, right? And then you still own the asset. And then you can take that money and invest it into others. So I think the compounding effect over time, and again, it's about getting the right investments and making sure you have the right team when you go into these opportunity zones. I think that's really critical, having somebody that understands in your group that understands the true valuation of the property and what you can realistically do. Because in these areas that are distressed and the different challenges with the culture and community, if you don't know what you're doing, I mean, there's going to be challenges that are going to rise. And so I think that would be the important things that to point out is the real benefit of what I see in the opportunity zones. And the other part is to making sure that you have the right team together, that you know what you're doing.
Yeah, I think that's very key to have the right team together, and also the right opportunities. There's also likely going to be scenarios where investors are aware of the tax benefits. They may be familiar with the idea of investing into apartments, but are they connected with the right team that has the right set of opportunities, and is there the right system in place to take advantage of those all together? And not that we haven't come across folks that are doing it in a different way, but typically the teams that we put together are they're very sometimes there's up to 5 different groups involved, and a lot of those relationships they all mirror each other, so we're all working together.
Correct.
So this is pretty important for us to kind of share with people that we've been speaking with lately, and I think that as we continue to grow through this new market cycle that we're kind of witnessing right now, one of the last things I think that we want to help people understand is that despite the headlines and despite the I think I would just say almost the habit of looking at how the market may be changing, or the S&P or the Nasdaq, or things around the world are kind of getting dicey and nasty, market correction. This is really a silver lining for the market, in terms of for investors. And so a lot of our conversations right now with investor groups are, really guiding them and coaching them to help them understand about, what they can do from an allocation point of view to take off risk from the general market, step away from that very sticky correlation that most people and investors and larger investors are, have been holding on to because it's been benefiting them. They've performed greatly on the stock market. And so for, our market and our strategy, it's providing a sense of relief from a tax point of view, but also from just a general correlation and volatility dampener point of view. We believe in private real estate for more than just the reasons of tax advantages, but in a sense, it is a business that has its own unique pillars that it really builds revenue off of. I'll leave it last part ending for you, Robert, if you have anything lastly to say, and after that, we'll kind of finish up.
No, I don't really have anything else to say except, that, again, we're really looking to, come alongside other groups and serve other groups that are already making an impact and want to do more. And a lot of the groups, as you know, Dylan, that we're partnering with, are best in class. Like I just put a partnership, well, we haven't finalized it yet, but one of the top 15 affordable housing developers management groups in the country, and put that partnership together, right? So we'll aggressively be acquiring and developing affordable housing, and a lot of it is in opportunity zones. As a matter of fact, we're underwriting one right now in an opportunity zone. So I think there's going to be a lot of opportunities for other investors and other groups that want to, either joint venture with us or for us to come alongside them and help them in, their endeavors to go into the opportunity zones.
Yeah, that's important. I think the last thing I'll say is that, when it comes to the idea of what this means in terms of actually getting involved, it's not more of a client relationship. It's truly joint venture. It's partnership. Even as an investor that maybe wanted to be more or less passive as a limited investor, there's a unique style of relationship that is available here that I think most that would be familiar with like a traditional wealth management model are used to. But the way we operate as a group is that we're looking to guide and teach and pour into our relationships as really extensions of our group, and in some cases of our family. So that's just been my experience. Obviously working to date with Robert, some of the other partners involved. So, and that's really what we want to carry on for everybody else. So thank you for everybody joining us today. As I mentioned before on the previous one, this is going to be something that we repeat, not every week, but every other week. We want to be respectful of people's time and also our business and time that demands from us. So every other week, we're going to kind of have a check-in webcast. As we build upon this, I think possibly the following webcast will have some time to do a bit of analysis on active potential investments for acquisition, as well as past successful success stories as well. So I thank you guys for joining us, and I look forward to learning more about everybody as we sign off.